Hey traders, Gavin McMaster here from Options Trading IQ, and today we're comparing naked puts with bull put spreads. Before we get started, just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. All right, let's get started. Both naked puts and bull put spreads aim to generate income, but they're as different as night and day when it comes to risk and reward. Let's compare the two and look at some examples. Firstly, naked puts, here's how they work. We sell a put option without any protection. We collect the premium up front, potentially buy the stock if it drops, and we have unlimited downside risk until the point of the stock reaching zero. Bull put spreads, on the other hand, are a bit more of a safer approach. We still sell a put option, but we also buy a lower strike put for protection, and that really caps our capital at risk and significantly reduces our max loss, as we'll see in a minute. So we've got limited risk and a defined max loss. Let's look at some examples. We use one of the most popular stocks in the market for our example. We're going to look at NVIDIA. And we're in Interactive Brokers Risk Navigator here, which is what I use to analyze all my option trades. We're going to go with a slightly longer term trade, 49 days, just to generate the extra premium. And we're going to look at a 28 delta. So we're going to add that one, and we're going to add this one as well. Now, firstly, the naked put. If we sell that 28 delta put, let's add in our expiration date and our T+0 line. And we can see here, actually, before I zoom in, we can see here we've got unlimited risk up until the point of the stock going to zero. We could lose potentially 14,000. And it doesn't look like a very attractive risk return proposition, does it? We're going to generate $410 in premium, which is our maximum profit, but we've got a huge potential loss. Now, it's unlikely NVIDIA is going to go to zero in the next month and a half, but that is our maximum risk. That's the amount of capital we would have to put up in a cash account. Not talking about a margin account here, but if we were to potentially get assigned on this put, we would have to buy the shares for $145, less the premium. It's going to cost us around $14,000 to buy those shares. Now, most people are sort of only interested in this piece here, the income potential, but they don't think about the risk. But what we can do to significantly reduce the capital at risk and the maximum loss is to turn it into a bull put spread by buying one of the 140 puts. Now, if we look at this trade, we've got less profit potential because we're having to buy this option. We receive $410 for selling this one. We have to pay $290 for buying this one. The net premium is $120. That's our maximum profit. The maximum risk, because we're $5 wide, would be $500 less the premium received. We can see here maximum risk of $380. Let's just run some rough numbers in Excel. With the naked put, we're receiving, say, $410 in premium, but we've got roughly 14,000 of risk. So that's a return potential of 2.93%, which, to be honest, isn't bad in just under 2 months. But if we compare that with the bull put spread, we've got $120 in maximum profit and $380 in max loss. We're now getting a 32% or 31.5% return on our capital at risk. So you can see that bull put spreads are a much more effective use of capital. The other thing to consider is that not everybody can do a cash secured put or a naked put on a stock like NVIDIA, because not everybody has $14,000 in their account. Even if you've only got an account size of 20,000, you can still do this trade. But if you do get assigned that 14,000 into NVIDIA, you've only got 6,000 left in your account. So the majority of your account is exposed to that one stock. So cash secured puts or naked puts, or if you're going to turn it into a wheel trade, you do require quite a bit of capital to do those. Whereas with a bull put spread, as you can see, you can do that with very little capital. In this case, we're only needing about $380 of capital to make this trade. Now, with naked puts, you can roll the position and try to avoid assignment, but chances are eventually the stock's going to have a decline and eventually you're going to get assigned. So you do need to have that cash available to buy the stock if called upon to do so. So as you've seen, some of the key differences within the risk profile, naked puts have unlimited risk, whereas bull put spreads have limited risk. In terms of the premium, naked puts are going to generate a higher premium and the bull put spreads are going to have a lower premium, but the return on capital is actually higher with the bull put spread. Capital requirements are very high for naked puts, whereas bull put spreads are much more capital efficient. So always remember to focus on risk management, especially in volatile markets, and adjust your trades as needed. Make sure to check out all the resources in the description below. Reach out anytime with questions and have a great day.